Okay, let's go ahead and get started. So this is the Blockchain and Financial Services panel. I'm going to go ahead and get started just by giving a very quick introduction. I'm going to allow our panelists to introduce themselves and give their background and what they're working on. My name is Steve McKeon. I'm finance faculty at the University of Oregon. Have been studying blockchain for some time. So our panelists here are Ryan Gaylor is the Director of Corporate Payments at Ripple, substantial experience across fintech, treasury, and capital markets. And then we also have Mayur Kapani, who's the CTO at Intercontinental Exchange. So Intercontinental Exchange oversees all technology groups, including NYSE and Interactive Data. And so I'm going to go ahead and just allow the panelists to start with an opening statement. Ryan, you can go ahead.
Sure. So very excited to be here. When I was first introduced to Ripple and asked to join the company, I was coming from a world at Reval where we helped corporates manage their global cash and global liquidity. So I had seen firsthand the challenges that are associated with global payments, particularly from a cross-border perspective. And where I was at another startup and things were going very well. What I just started looking at is that, Ripple was kind of in my mind and just kept rippling because I started thinking about the implications of solving these cross-border problems. What we look at is, from our vision, is the Internet of Value is the way we refer to it. And that means that value can move just the same as information does today. As a quick example, one of the large customers that I worked with at Reval, we actually saw where, as a company, they were telecom infrastructure, global operations, so they would have engineering teams like any other type of company today that could do video conferencing from different continents, share design specs instantly, have all of that information. Yet for them to move money from one country to another could take as much as 11 days. 11 days, and they're building infrastructure in emerging markets. So what does that mean? How often do they move money to fund those operations? They actually move it almost once a quarter. That increases their FX volatility. It's a massive cost to the company, which is then a massive cost to the infrastructure build of that country, that emerging market country. That's absurd, that actually still exists today, when you could, other things are possible. So what we're trying to do is break down the barriers, the friction that are associated with moving money cross borders today.
Thanks, Ryan. Can you hear me now? I just want to make sure everybody is good. First, thanks to the McCombs School to invite me to participate in this panel. It's been great hearing all of you, all the great questions, so looking forward to some of them. So I'm part of the Intercontinental Exchange group. We run 4 US equity exchanges. One of them, most people are familiar with, the New York Stock Exchange. We acquired actually one more last week. So we run now 5 US equity exchanges, 2 US equity option exchanges, 7 derivatives exchanges all over the world that trade energy, agricultural commodities, metals, FX. So we are in a credit default swaps. So we are in all these asset classes. So we run the derivative exchanges and the derivative clearing houses, 7 of them. We also run ICE data services, which essentially aggregates data from large number of sources, 800 of them to be exact, does analytics on that data and redistributes that data to all the financial market participants. So our business is data, our product is software which runs that data, and we've gone through multiple technology revolutions, going through the Intel Moore's Law, speeding up the way the analytics are done, speeding up the way the transactions are done. We've been through the internet revolution where we've seen the connectivity explosion where a common man can, or a retail consumer can interact with the markets much more transparently, much more cheaply. $595 stock trades. I mean, this was unheard of just a couple of decades back. So we've been part of that revolution, and we've also been instrumental in converting many of the markets that were analog, which were essentially being traded on the floor. If anybody remembers Trading Places, New York Board of Trade, that was the one we actually completely converted electronic. I think 7-8 years back, we acquired it and made it completely global. So I've been part of the technology revolutions, been part of this industry for about 28 years. And now we are looking at this new technology, blockchain, and we've looked at we've done a lot of experiments with it, all the public ones, the Bitcoins, Ethers, and Hyperledger. We've done the private ones, the Corda and digital asset holdings, and we've seen a whole gamut of them, thought about it in terms of many of the use cases they apply to, where they work, what they don't work, and I hope I can share some of those things. In this space itself, we did investment in Coinbase way back in 2014, so we've been kind of watching this space, and also we have a product that aggregates data from the top 14 crypto exchanges and redistributes it. So we've been pretty involved in this space, and we've been experimenting a lot with it. So I hope to share some of our experiences, and hopefully I can share something which will be useful to this group, and looking forward to all the questions.
Thank you. So since this is one of the smaller panels, Chisar asked if I would participate a little bit as well, so I'll also just give you my background briefly. So long before I was a finance professor, I started my career in tech. So I joined a Web 1.0 venture-backed startup in March of 2000, which is possibly the worst moment in history to start a career in technology. So I eventually did go back to school to get my PhD and started at Oregon in 2011. And shortly after I got there, I sort of re-engaged with tech because some MBA students and I started a drone software company. And so I watched it from birth through venture financing and eventual exit. And that is actually where I became acquainted with blockchain technology. It was interesting because I knew, working with commercial drones, I was never going to be a domain expert. And so I was looking for something where I could merge the sort of formal training in economics and finance with sort of all this experience in emerging technologies. And as soon as I saw blockchain, it sort of fit like a glove because there's just so many dimensions. So I teach valuation, so I was able to think about how and why would value accrue to these assets or maybe not accrue to these assets. It allowed me to think about, my doctoral thesis was on equity issuance. So I was able to look at ICOs, and there's some innovative issuance mechanisms, and how do returns, correlate with the characteristics of a research project with Professor Fracassi on that. And so, the interesting questions will often lie around this idea of financial services because many financial services involve intermediation. And intermediation can add value, that's why the model has arisen, but it also can add cost and latency. And so it's really interesting to think about how blockchain might mitigate some of those frictions because it could move us towards what we think of as complete markets. So the idea that to the extent we can relax some frictions to trade and to issuance and reduce the cost of issuance, we might be able to price more assets in more states of the world. So to an economist, that's a really interesting concept. And so we will go ahead and move on to the topic at hand and some questions for our panel. So I think I'll start with Ryan. So blockchain and financial services, you often hear this term disruption. Where are you seeing application versus exploration at this point?
Yeah, so like any disruptive technology, it all starts in the innovation lab. And we started in the same place. I think, for a lot of organizations, we were talking a bit before the panel started, and, the previous panel where it's talking about logistics, there's regulatory aspects of that, but the regulatory important side of things in this side is very critical. So as a result of that, it drives a lot of innovation lab, looking at it first, testing it out, things like that. The exciting thing is things are kind of turning that curve. We saw a turn in that curve last year where we started having a number of clients go production, where they were actually moving real funds, making real payments using the software. I think one of the things to look at that, though, is that because of the regulatory aspects, which we'll talk about that more, and there's other sessions today, it's not going to be an all or none type of approach. There's going to be stepped approaches for how it's used. And you see a lot of, this is almost like a religious debate when you start talking in some groups of blockchain and the different coins and the different models. And you need to kind of take it away and say, what is the core of what blockchain enables? It's distributed ledger technology. It's building trust. When you look at a cross-border payment, what is critical with that is that there is no central ledger. You're dealing with two independent ledgers, and you need to be able to create a link for them to have that settlement. And so what we've seen is that the stepped approach that's being taken, and that where we've seen the greatest adoption from banks, is using a product that has aspects of blockchain technology that uses what we have called our interledger protocol, which is a W3C open source standard that we've promoted. And basically that allows the opening and creating trust between two independent ledgers as sub-ledgers to a core ledger within a bank. I look at it and I really think that is kind of a stepped approach towards the adoption of digital assets, which requires greater regulatory certainty, as being akin to Netflix. When Netflix first launched, how did they launch? It wasn't streaming video. They launched with discs in the mail, and you managed to queue online. So if they launched straight out with streaming video, there just wasn't that capability. Buffering would have been constant. The adoption would have failed at that point. Whereas now you're actually seeing the full delivery of the vision that they had from the beginning. But they did a lot of innovation in envelopes and delivery and things like that to get there.
Great. So, Mayur, one of the things that's often talked about with blockchain is this idea of immediate settlement. Mm-hmm. And so when we think about things like the New York Stock Exchange, settlement is on the order of T+1, T+2. Kind of walk us through what's happening during that period and what sort of frictions might blockchain be able to relax and what things are going to be a little tougher to solve.
Sure. So it's a very good question, and I always hear people say, you know what, it's taking too long look at this T+3 settlement, or now it's T+2 and in the process of going to T+1. Look at all this, how long it takes, I want my money now. But if you ask the same person, okay, you want your money now, do you want to buy thing on margin, or are you going to have all the money when you want to buy stock? Are you going to have stock in your portfolio before you can sell, or you need to borrow? Once you go into those kinds of scenarios, people say that, oh no, I really want to be able to borrow the stock whenever I want to. I really want the broker to give me a 50% margin, which means that I need to put up only 50% of the cash. And the rest of the cash I need to give later. I really want services like when something goes wrong, I can call you and blame you and give me the money for if something goes wrong with the system. When you add all these things, what ends up happening is you require a set of processes which are non-fully collateralized. What that means is that I need to have the money, full amount of money before I can buy anything. I don't have the flexibility to borrow. I don't have a flexibility to take credit. So whole bunch of things, kind of problems that come up that can't be solved by immediate settlement. And when you talk of scale, just to give you a perspective, between our equity exchanges, we get multi-billion orders a second. Of these multi-billion orders, 20 million get into settled transactions. Maybe it will reach there, IBM will get there, and others will get there. We are very far away from any kind of blockchain technology to support this kind of stuff. And immediate settlement, as we talk about it, has all kinds of problems and challenges where the multiple parties that are involved, that manage fraud, that manage risk, that manage finality of settlement, which says that if you bought IBM today and want to get the cash immediately, there is somebody out there who will make sure that the cash is really the cash you have and nobody's going to back out of that transaction. So those are all the things which are in the way of immediate settlement. We can start with simpler transactions which says that, okay, I am holding a Bitcoin wallet on one side, there is a Bitcoin wallet on the other side, you're taking the full risk, you send the money to the other side, you're taking the full risk that the address you typed in was the address you intended, there was no fraud, and all the risk when the money doesn't get transferred is on you. So we have to get from there being completely trustless to somewhere in the middle where some amount of trust is needed, and we are making this system much more efficient compared to what it is right now, and that's where I see the opportunity. But immediate settlement, as I see it, there are a large number of challenges. They're not necessarily technical, but business process challenges to be able to achieve it at this time.
Great. So you mentioned regulation. It was mentioned on the prior panel. I know we have a whole session on regulation later today. But regulation is something I think a lot about. I advise a project called Harbor that's trying to deal with permission layers on public chains. And so I think just with respect to this topic, financial services, could you talk about how regulation impacts each of your respective areas?
Sure. So as we were saying before, it's critical from our standpoint. And I think one of the things that we've seen early on is that the blockchain movement, starting with Bitcoin, kind of went in the face of regulation. And there's some discussion out there that you could actually see where it's almost like the Napster, where it was the first one, it was the innovative, it created the movement. But then because it didn't kind of work within the regulatory framework, it ends on that basis. You have to work within the regulatory framework. As a funny story, I've been in different roles. For the first time ever, shortly after joining, my sister called and said, Dad's worried about your new job. And I was like, well, what is this about? And she's like, well, he read some Tom Clancy book and they were talking about using Bitcoin for funding terrorists. And he thinks you're somehow tied up in that. And so after a couple conversations where I was like, why is that black van still out? I kind of goaded him on that and kept saying things like, did you hear that? It sounded like someone else was listening on the line. But what we do is we fully embrace from the regulatory standpoint. And the way we look at it is banks need to exist, okay? It's the insurance framework in most countries from a depository balance. It's all of these things. But most importantly, it's the KYC, or Know Your Customer, and anti-money laundering laws that need to exist out there. The problem is in the lack of the regulatory certainty. What's happened is you've seen a lot of institutions pop up that actually create more of a risk around the regulatory issue, where you've seen the crypto exchanges being hacked and the lost funds. It's because the experts that manage markets that exist today, they can't adopt it because it's just not possible. For those who follow Ripple, you'll see all the time people saying, the banks, they're not using XRP. They can't yet. Many of them have worked with it. They've tested the use of XRP. But until there's regulatory certainty, they can't leverage it today. So that's where we work with other types of institutions within the regulatory framework that don't have the same type of regulatory pressure on their side, that still, again, complies with the KYC, AML type of checks. But they're taking that stepped approach of using what they can from blockchain aspects in our other products to enable fiat-to-fiat currency payment settlement. So we're big advocates. Every time, before we can work with a bank the first time in a country, there has to be that regulatory certainty, that the bank gets the clearance from the central bank, that they can use our software. And the amazing thing is that we've seen some significant developments. One of the announcements we had earlier this year was SAMA, the Saudi Arabian Monetary Authority. They actually brought a group of banks together to create an initiative using Ripple for cross-border payments. So in that case, we're actually seeing an increased adoption from central banks. And one of the amazing things when we talk to different companies and prospects is if you look at our adoption is absolutely east to west across the globe. And it's no wonder, because when you're the U.S., you're dollar denominated. You get to dictate to everyone, take my dollars, take my dollars, take my dollars. It's not that hard. Plus, it's a large, domestic economy as well. When you're in Thailand or the Philippines, in those areas, you need to, your current cross-border transactions are a much greater percentage of your transactions for every individual, every company. A lot of the initiatives that we see driven from a central government perspective is actually driven around this. When you look at it, India, parts of Africa, Mexico, consumer remittances are a major factor in their economy. So the SAMA initiative was one of those types of things where it's driven by there. In the Middle East, there are major outbound remittance or originating corridor for a lot of different countries. The problem is, in today's traditional cross-border payments rail, for the person that's sending $100 or $200, that's where it's the most expensive. They're paying upwards of 20% of the transaction value to send that money. So if you're in India and you're the government and you're thinking about it, what's the problem that I can solve? If they can bring that down to 5%, that's an incremental 15% that's actually brought home of that transaction value that gets to be used domestically. And they've tried different mechanisms on times in terms of how foreign exchange works, but at the end of the day, this is still a market that is dominated by the large correspondent banks. And the way that we view the regulatory approach is we need to work within that framework, but the kind of control that happens where to send money from Kenya to Ghana, you have to go through the US or London, that's kind of absurd. So that's what we're working on.
Great.
So for us, we are in Asia, Europe, and the Americas, and we actually are regulated by about 18 regulators. We have a full alphabet soup, which we need to worry about, where we report to them data, they audit us, they make sure that our system safeguards in terms of cybersecurity, in terms of how we build our systems, how we test our systems, and what liabilities we take on when there is an issue. We have to go through all of those things and depending on which part of the world you are on, people have different views on how strong or in a full spectrum of how strong those controls need to be for mitigating some of the risks. So the regulation, at least the way we look at it, is not an end in itself. It's a means to establishing accountability when there is an issue. When there is, we have bankruptcy laws because when there is a default, you need to know who's going to hold the bag, how are you going to mutualize the risk, what is going to happen. And most of the developed countries, especially in US and Europe, are totally pro-consumer. So independent if it was consumer's fault what he did, lot of the bias is towards institutions taking the risk for making the consumer whole. So regulation is a means to an end, means to a better risk management in our world, and we respect that, and we build networks and our networks and platforms and processes to abide with that regulation. And one of the challenges with the blockchain technology, and it's not so much the technology, it's the social side, is getting some sort of legal finality and certainty when something goes wrong. When things are good, nobody steps in, everybody's happy. It's when things go wrong, when an exchange gets hacked and 500 million disappears, who's going to hold the bag? When a transaction is done by somebody at E-Trade and that transaction doesn't show up and that guy doesn't get the cash, who's going to hold the bag? For transactions that have like options and futures that are derivative instruments that have a long life. In between the, while the transaction is in progress and the contract is active, if one of the party defaults, who's going to hold the bag? So those are the kind of things which the regulation and the systems that are built in the current financial infrastructure cater to. And that's I see the challenges. Adopting a technology like this, it needs to solve those problems before we can consider it useful for some of those use cases. So that's the way we look at regulation and what are the challenges this technology needs to solve and do it in economically beneficial way before we can start thinking of applying this technology in many of the use cases we worry about.
Thanks. So let's talk about how financial services, may be disrupted or how incumbents are kind of thinking about this. You mentioned the investment in Coinbase earlier. To what extent is your organization, sort of testing this technology through investments versus, sandboxing it in-house? Yeah, please.
So we are obviously one of the ones, we've been a vehicle for disruption in our markets, turning markets from analog to digital, leveraging the internet technology for distribution across a large number of consumers, building networks. So we've been the disruptors in the past, and we obviously don't want to be disrupted in the future. So we actively are working on, have a whole lab where we experiment with all the open source technologies and have partnerships with a set of private blockchain ventures who are solving interesting problems to determine whether technology is, or at a given stage of maturity of this technology, is it going to fare much better than what we have today, and actively develop those use cases. I don't have Frank and others who have had the opportunity to take it to production. I cannot say we've had the opportunity to take it to production because we've run into some issues biggest one being regulation and the others being aligning everybody in terms of incentives to adopt the technology to take it to production. The other thing we've run into is getting consensus on workflows and also reaching an agreement on how the software which we are using is going to be governed. How are changes going to be implemented? Who's going to authorize the changes? So we've run into these issues, and more we try to run and solve these issues, which are not necessarily technology issues, we find that it looks more and more like what we are doing right now. So we are really focusing hard on looking at technology and identifying what are the specific outcomes we are looking for using this technology, which are much superior to what we do today, and trying to work backwards and see, okay, whether this technology is applicable to solving those problems. So I don't know, that's the way we look at it.
Absolutely. We're at the 15-minute mark, so I thought I'd open it up to audience questions, if there are any. Start over here.
So how do you guys envision retail eventually interacting with blockchain? Is this something where, because right now you guys are typically dealing with more institutional, more large transaction type stuff. So I guess, yeah, where do those retail customers come into play? And because like one of the biggest things is private key management is a nightmare, and it's not something that the layperson can do. So how does that work?
So I can try to answer that question. So if you look at the retail space, yeah, sorry. The question is, how do we get, as I'm assuming this is a question for me, we cater to institutions and we also cater to retail, but I'll speak a little more about it. How do we expect to get more retail participation and be part of because the retail, currently the biggest risks faced by retail in dealing with crypto is the private key management and all the issues related to it. If you think of it, this is the evolution, this story has played back before. Think of stock certificates. And I might get the date wrong, but I think it's 1880s or around that time, till about 1950, people used to actually exchange stock certificates. They used to own them, they used to exchange with them, and then people said, this is too inefficient. Everybody, and what happened in 1929, what was very interesting, when the market crashed in 1929, they had to close the markets because they couldn't keep up with the paperwork of exchanging stock certificates between people who bought and people who sold. That's where we are. Even though we are in digital form, this is where we are in terms of the cryptocurrency market structure. What we see it's going to evolve to is there are going to be specialists who are going to do the work for you to keep your keys or keep your ownership with you, with them. And I know this is antithesis to all the decentralization and everything this crypto stands for, but you will need, when you're talking about a little bit of money and people can use it, yes, you can keep your own keys and be happy with it. That's why you keep cash in your wallet, $200. You don't care whether you lose it. But when it's your retirement savings, $1 million, you're not going to keep it in your wallet. You're going to give it to somebody, hold them accountable for keeping it safe, and that's where this market is going to evolve. And the way it's going to evolve, I strongly feel it's going to be much faster than the other markets evolved, but the way it's going to evolve is you are going to see the E-trades, TD Ameritrades, coupled with some institutions, obviously we would like to be one of them, where they will help the retailers, retail consumers, to manage their crypto, not through private keys. They will take care of that, to show up in their balances when they log into the website and say, okay, I can see it. Along with my IBM stock, I have Bitcoin, 7 Bitcoins, which are valued at X. That's how the market is going to evolve. Right now, it's at least my perception, it's the Wild Wild West. And markets always start Wild Wild West. Then people see the demand, markets grow, and we've seen this story multiple times because we even see it in some of these esoteric markets which are non-digital, which are being traded on the phone or done with chat, where they evolve as the demand grows, as the number of participants grow. Institutions have an incentive to provide services which take away all the complexity and simplify it. And that's what we see. And that's how I expect the retailers to come into the ecosystem. I don't know if I answered your question or not. So.
I would also add that the end consumer doesn't actually have to touch it in the same way that you think, where they have to manage keys and things like that to get the benefit of it. If you were an individual that's sending remittances from the U.S. to Mexico, one of the things that we have out there is that instead of managing that individually, doing a fiat currency transaction and the costs associated with that, it's a service that is using those U.S. dollars you have to buy XRP, send it cross-border, then use that XRP to buy Mexican peso, and it receives the end beneficiary. A transaction that takes 2.5 minutes and at a fraction of the cost of a payment today. So they didn't have to touch XRP. They didn't have to do it. They worked with an institution to do that. Or Santander announcing yesterday that as a bank, they were launching the first payment app powered by blockchain capabilities. And I think they say 3 clicks, 40 seconds. So those are the types of things. Those consumers don't have to touch any of it directly. They're working with a provider that gives it to them.
Great. Why don't we go here?
Questions to Mayur and with IBM transparency. You mentioned that you've been experimenting with multiple, just primarily permissioned blockchain DLT variants. So you mentioned hyperledger fabric, Corner, Corner. Just curious what your experiences are.
So experiences are, and again, this is just give you a perspective of Bitcoin started with being too simplistic. Ethereum started being too complex. Hyperledger has had like 4 incarnations, and it's been hard for us to figure out what actually to use. I'm just giving you a very honest view. Corda is still work in progress. Quorum, which is an adaptation, which is, just to give for this group, Quorum is something built by JP Morgan where they took the Ethereum and created a permission chain using a set of services with a different consensus algorithm so that you could improve the performance. Quorum has been a positive experience because they have simplified the use of Ethereum by reducing the amount of complexity, limiting the amount of complexity what a user of the blockchain needs to do. And they are more, because they are a financial services player, their implementation caters to many of the financial services needs. So that's my short answer for what we've experienced.
What you were talking about in terms of market crash, maybe think in terms of Ripple and in terms of these counterparty trades, looking at what happened in the 90s with the Thai baht, the peso, the ruble was plummeting, how do you hedge, how do you avoid risk if there's a currency that suddenly collapses, you have no counterparty within Ripple?
Within Ripple, so right now, are you saying in terms of XRP to those different currencies?
The XRP requires you to exit on the other side, and if the currency is rapidly changing in value, how do you hedge?
Yep. So what I would say is, and this is a question gets all the time, because let's be honest, the digital assets are very volatile. What I look at with it is that the difference is, if you're doing USD to Mexican peso, it could take a day plus for the settlement and everything else. And it's less volatile than a crypto, but if you're working with a digital asset that settles in 3 seconds, then your tick volatility, your time volatility that you're exposed to is actually far less. And that's the difference there. So, when you look at it, it's not that exchange happens so fast that it's great. Now, clearly, someone that's in Thailand that they're determining their balances between a digital asset, any digital asset, and their fiat currency, that's an individual risk question that they have to take. But I think when you look at that, that's where the adoption of digital assets has taken off. I think one of the hardest things when I first started talking to people about digital assets is, the concept of why? Why would you buy it? It's like the average person in the US can't get the concept, but someone who's been exposed to hyperinflation 2-3 times in their lifetime with their fiat currency, they can very quickly. If there's something that has a control to the supply, if there's something that has kind of is not exposed to the corruption of their local government, that's a benefit. So, I think in terms of where it works, in terms of the greater macro scale in economic crisis, it'll be interesting to see. It's been very interesting for me to see more stabilization on a relative basis in a lot of the digital assets after the spike earlier this year, which is a very seasonal phenomenon that you can look at, relative to the volatility ramp in a lot of traditional markets, over the last few months.
And I would just weigh in quickly on the volatility question because I've spent a lot of time looking at so-called stable coins. And the use cases for those are where there's some sort of temporal delay, right? So if a payment's cleared in 3 seconds, it's not as much of an issue. If the moment of contracting and the moment of delivery are separated in time further, like in a lot of debt contracts and many other applications, the volatility becomes a much larger issue. All right, so moving back here. Yeah, so I would say it's definitely not settled, right? So people are trying to apply a lot of different models. So people are using this so-called MVPQ kind of, formula for, the way we might look at currencies or something like that, or the Baumol-Tobin model. We don't have all the answers. I mean, I think the reason you're seeing some movement with prices moving with adoption or on-chain transaction volume is a metric that people often look at. So people are looking at adoption the same way you look at adoption for an early stage technology, right? So to the extent you see more people adopting it, perhaps there's more reason to think that more people are going to hold it, increasing demand. I think most of the models that, for the pure currencies, people are looking primarily at sort of supply and demand for currency types of models, but the short answer is it's definitely not figured out.
I'm having a hard time understanding the intrinsic value of cryptocurrency because I listened to you talk earlier about the financial services industry. It seems like the drag or the friction, if you will, for creating currency is not from the currency itself, it's from the need to have financial services and cover the risk of fraud and insurance and things like that. And if we bring those things as banking institutions into cryptocurrency land, well, we've added the same transactional costs, the same cost of labor, the same friction. So I don't see the advantage, I don't see the intrinsic value, so what am I missing?
Yeah, I'd be happy to take this one. So when you're doing a cross-border transaction today, you have to, it's dependent on using Nostro and Vostro accounts within the correspondent banking network. For anyone that's not familiar with that, for two banks to have an interaction cross-border, one of them has to have deposits at the other bank. What that creates is it's idle liquidity, it's idle cash, it's idle resource. And then you add on top of that, because of the complications around that, and again, they're independent ledgers, so even though this one will say, hey, I just took on, 50,000 US dollars, I'm going to, use my Mexican peso that I have at your bank to pay out someone. And that's effectively how that transaction occurs. They're two independent ledgers. How those payments are done most of the time today is through SWIFT, which is just a message. So the corporate that's sending that payment, they send a payment on, and it's bye-bye. Like, they don't get, okay, I'm going to send it. They usually, a sophisticated corporation will say, I'll pay this type of spread. They have pre-negotiated rates. But the amount that gets sent over on the other side actually isn't known. They won't know precisely how much. Now, they can say things like, set a payment to say, I'll pay all the fees that occur, because they can incur different lifting charges and fees that come through the other side. But that payment just gets sent from one step forward, and that's it. They may get what's called an ACK message that says, okay, I received that, but then it goes on. And each leg of the way has to go through their own settlement, KYC, AML process, et cetera. One of those can fail because a digit's off on the address or something like that the other one doesn't recognize, so that got failed. I'm sending back this message. Now you're 5 days later, and there's no efficient mechanism for bringing all of that back.
You're disintermediating the settlement supply chain.
So yes, because with what the digital assets, so what we do today is leveraging elements of blockchain is to make that what we call an atomic settlement, where everyone agrees it's a more bidirectional messaging, everyone agrees they have a subledger, which is the aspect of like a distributed ledger, and they all agree, okay, transact the funds at the same time, and they're agreeing on fees. Digital assets remove that you may need to, that it may take 4 banks to make that transaction. You can make it more simple where it's just 2, because where you can't make a dollar magically convert to a Mexican peso and be sent over, you can take a dollar, buy a digital asset, and that digital asset can be transferred to someone else's ledger very efficiently.
Thank you, Steve. And to all three of you, Ryan and Mayur, thank you for your service today with us. My question is very simple. Could each of you tell us what you're using as a digital wallet?
You're never supposed to tell people those things. Sure. So I guess broadly speaking, so if you look at exchanges, I'll speak sort of generally about what.
I'm asking specifically as
Nano.
experience do you, right, that makes sense, right? So
Yeah.
what experience do you have with using a digital wallet? I mean, what would you tell us what you've used?
Yeah, I mean, I think for the hardware wallets, like Ledger. Yep.
Okay. You don't have to tell us which one, but that's a reasonable answer. I've asked this to multiple moderators. I've had some people say, oh, I haven't used one. But yeah, they're talking about blockchain, which is totally cool, right? They can look at it academically, but that's why I asked this question.
I would add also that I interact with a lot of institutional investors in this space, and some of them are actually comfortable keeping them on exchange with, for example, Gemini. So Gemini seems to be a highly trusted custodian. And you're actually seeing a lot more of these custodian services rise up, like Coinbase is starting a custodial service, right? Anchor is a custodial service. So I think we're just out of time, but custody is a major issue.
So hot wallets, we have tried all of them. Blockchain.info, or you go to Coinbase, or there are multiple of them, Taser, but we don't keep our real money there. It's in a passphrase in a vault.
Yeah.
So yeah, it's a core.
No, and it gets to the retail question as well, because when I left on an international trip recently, I was trying to have things in order, and I was thinking, I told my wife, look, if anything happens to me, just talk to Neil, my coworker, and he'll sort out the digital side, because I can't just easily explain to her how to work that. She can go onto the 401k, the brokerage sites, et cetera. That's more difficult.
That's a problem. That's the problem needs to be solved. Yes.
And that's where I think the custodial firms, that's where it's going to move towards.
All right, I think we're out of time. Thank you very much.